Hey everybody, I'd like to wish you a happy new year, even though we're halfway into January. Feel it's still not too late to be optimistic and hope for a great 2022. And with that said, I want to bring this 2022 market forecast to you to talk a little bit about the future of mortgage rates, interest rates, as well as the housing market. And just to initiate this, let's just start with a recap of 2021, because in 2021 we did expect interest rates to rise in the first half of the year, and this was in part due to a new administration with a little bit more stimulus and spending, but then we thought we would see the rates recover into the fall, and it turns out that was true. The rates did come back down, albeit a little bit sooner than we expected, more like in July and August the rates started to come down, but anytime we see lower interest rates, that's always welcome news. Housing we had forecast to be very strong, and we thought it was going to be in the high single digits due to the issues with tight supply demand already, and with the demographics of we having a lot of millennial age buyers. So millennials are in their 30s, and the median home buyer age of a first-time home buyer is about 33 years old. So all these people born in the late 90s now, or early 90s I should say, are coming of age to become first-time home buyers, which is putting a big demand on the market. In addition to COVID curtailing what builders were able to bring to the market, it made a tight housing inventory situation even worse. What actually happened is that the home price appreciation was up double digits. So we kind of missed that. We didn't think it was going to be that good. But as I said, due to the circumstances that I just mentioned, home prices went up much higher than expected. So looking forward to 2022, the Federal Reserve is going to be a major player in the markets, not only the mortgage market, but in the stock market and to some extent the housing market. The Federal Reserve has a mandate right now to deal with inflation, which we see has been hotter than in the last 40 years, basically the hottest it's been in the last 40 years. So what they're going to start to do is taper off their purchase of mortgage-backed securities and treasury bills, which will in turn cause interest rates to rise a little bit, and then they could actually start to hike rates. They have said that they're going to raise rates 3 times in 2022, and so that's the Fed funds rate. And so this is where it gets a little confusing sometimes for consumers. People assume that if the Fed is raising the rates by 1/4%, that must mean mortgage rates are going up 1/4%, but they're not directly linked like that, and we'll discuss that in just a moment. And then the last thing is this balance sheet runoff. So the Federal Reserve has been purchasing mortgage-backed securities and treasury bills, and as new loans are paid off, is the Fed going to take the funds that they used to pay off those loans and buy more mortgage-backed securities, or are they just going to let it run off of their balance sheet? If they let it run off, that could cause additional upward pressure on rates. So this is going to have an impact on the equity markets, like the stock market, also the interest rates as we discussed, and the housing market, and even the jobs market to some extent. So important thing to understand about the Federal Reserve is that there are 19 members and 12 of them vote. So the current composition of voting members are a little bit less accommodative, meaning they're a little bit more likely to raise rates in the coming year. So we need to expect that because fighting inflation is going to be their main focus. The Fed probably should have hiked rates sooner, like last year in 2020-21, but they said it was transitory. We're going to talk about transitory here in just a minute. And to help us understand the current situation, it's helpful to look back a little bit. So today's video is a little bit of a Federal Reserve history lesson, okay? And we're going to go back starting to the late 70s when the Fed chairman was Arthur Burns, and that's the last time we had really high inflation, much higher than today. But Arthur Burns was the chair, and he ignored inflation, which was rising rapidly, because he said it was transitory. And you may have heard that word a lot lately. Jerome Powell, the current Federal Reserve Chairman, has described the inflation as transitory, and others have described it as transitory, meaning it's passing, it's temporary, it's not lasting. Well, that turned out to bite us in the rear, because what happened is that the year-over-year inflation ballooned from 7% in '78 up to 14% by the time he left in 1980. And just so you know, the Fed funds target rate for inflation is about 2%, recently increased to about 2.5%. So to see rates go from the inflation from 7 to 14% is really, really high. Consequently, that higher inflation caused mortgage rates to jump from about 12% up to 18%. Now keep in mind, a 12% mortgage rate back in the day, in the late 70s, was considered a good rate. But then to see the mortgage rates go up to 18% was really painful for home buyers at the time. So in comes Fed Chairman Paul Volcker. Paul Volcker, in order to curb inflation, hiked the Fed funds rate from 11% to 20% in 2 years. That was very dramatic action that had to be done in order to get inflation under control, and he did. With that, inflation dropped from 14% back to below 5%, which was much more manageable than the high rates it had been. And because inflation dropped, mortgage rates also dropped from 8% back to what was at the time considered a low rate on a mortgage of about 12%. But there were consequences. The stock market didn't really like this, and it caused the S&P 500 to decline by about 30%. So the tighter monetary policy caused the U.S. to go into recession in the early 80s. Fast forward to Alan Greenspan, who became the Fed chairman in the late 90s. And under him, we saw inflation double from 1.75% to 3.5%. And with that higher inflation came higher mortgage rates. They went from about 7% to 8.5%. Now, I got in the mortgage business in the late 1990s, and when we saw rates around 7.5%, we thought, oh my goodness, I can't believe interest rates are this low. We'll never see rates this low again. Just goes to show you what a decade or two does. But rates did go from about 7% to 8.5%. Greenspan, on the other hand, had the benefit of hindsight of seeing what happened under Arthur Burns when inflation was ignored and considered transitory. So he took a more aggressive stance, and he hiked the Fed funds rate by 1.75%, matching the rise in inflation from 4.75 to 6.5%. So by doing that, inflation responded positively, and it dropped from 3.5% down to 1%. And consequently, mortgage rates also dropped from 8.5% to 5.5%, which caused a huge refinance boom. And again, we thought, oh my gosh, interest rates at 5.5%, they'll never get this low again. So it's just kind of interesting to see all perspective, right? But once again, there were consequences to this, and the S&P 500 fell 50% from the spring to the fall of 2000. Now, we can't attribute this all to only Fed rate hikes, because as you may recall, there was the dot-com boom followed by the dot-com bubble, which happened in 2000. So part of this S&P collapse was due to that, but also certainly some of it had to do with the Fed funds rates rising. And once again, the U.S. entered into recession in 2001. Now we fast forward to Jerome Powell, our current Fed chairman. And in 2021, just last year, we saw inflation go from 1.75% to 7% in 1 year. And Powell initially attributed that to being transitory. Well, does that sound familiar? Because that's what Arthur Burns said when we had out-of-control inflation in the late 1970s. Higher inflation caused mortgage rates to rise from 2.5% to 3.375%. Now, the reason why the mortgage rates didn't spike so much is because the Federal Reserve had been actively buying mortgage-backed securities and treasury bills. And by doing so, it helped keep interest rates low. But the Fed has said they intend to end tapering by March of this year, March 2022, just about a month and a half away, and then likely to start hiking rates in May. So they're probably not going to do both at the same time. They're not going to taper and hike at the same time, but by tapering, it means they'll purchase less and less mortgage-backed securities and treasury bills, and by not purchasing those, that's going to cause rates to rise. The Fed has targeted 3 interest rate hikes in 2022 and probably 3 more in 2023. But the good news is that when the Federal Reserve does this, they curb inflation, and that in turn gives bond traders, mortgage bond traders, confidence that the value of these bonds are still going to have value in the future, that they won't be eroded by inflation. So when they do that, it brings the mortgage rates down, sort of counterintuitive. The Federal Reserve, they hike rates, but mortgage rates in response come down. So that's what we expect to see in the later half of the year. So to recap, let's just see if we notice a little bit of a pattern here under Burns and Volcker, where we saw inflation in the 7 to 14% range, interest rates go from 12 to 18%, and then the Fed funds rate get tightened from 11 to 20%, and the inflation responded favorably by dropping from 14 to 5%. Mortgage rates also dropped back from 18 to 12%. But the consequence of that was that the S&P dropped 30%, and we had a recession. Under Alan Greenspan, similar picture. Inflation rose from 1.75 to 3.5%, not quite as dramatic, but he was quick to react. And similarly, we saw mortgage rates rise from 7 to 8.5% during this period of inflation. But with the Greenspan hiking the Fed funds rate to match the rate of inflation, it brought the inflation rate down from 3.5% to 1%, which is a much more palatable level. Consequently, interest rates dropped by 3%, which was a huge refinance boom. But the negative consequence was, again, the S&P 500 was down 50%, and that led to a recession. Now, we have Jerome Powell as our Fed chairman, and we saw rates, inflation, I should say, go up dramatically from 1.75 to 7% last year, and he has to do something about it. We saw interest rates only go from 2.5% to about 3.375%, and the reason why they didn't spike so much is because the Federal Reserve has been buying mortgage-backed securities and treasury bills. And by buying the mortgage-backed securities, that's sort of been artificially, not artificial in that it's keeping the rates down, but they've been sort of an artificial consumer. It's not, regular institutions that are going in and buying those, but the Fed that's buying those mortgage backs and helping keep rates low. Now, conversely, the Fed funds rate is at 0% right now, and they're expected to bring it up to 1%. So if you compare that to what it was in the late 70s, we have a much lower, Fed funds rate and a much lower hike forecast. So it shouldn't be as painful. And consequently, when the Fed does hike the rates, though, we should see inflation drop as it has in the past, and we should also see mortgage rates decline as they have in the past. Consequently, though, we could also see some impact in the stock market and the stock market decline. There are wild cards in this, however, the main one being COVID. We don't know what's going to happen there. There's been tremendous supply chain disruption, and the government may feel the need to stimulate the economy in order to, stave off some of the economic pain. But in doing so, that leads to more inflation. That's part of the problem that we've been having here. So the stimulus could push the stock market higher, but in doing so, that's going to push mortgage rates higher too, because the mortgage market isn't dumb. They know that this inflation is going to lead to higher rates, so we'd see higher mortgage rates. And if the Fed, or not the Fed, but if the government does want to do more stimulus, that's going to make the Fed's job tougher to try to corral inflation. So to recap, the Fed's runoff of the balance sheet, their first step is to stop purchasing the mortgage-backed securities and treasury bills. The next step is hiking the rates. Probably going to have 3 rate hikes this year. And then they'll stop buying, or will they stop buying, this $70 billion worth of mortgage bonds? So in other words, when a mortgage pays off, and the Fed has that money, are they going to just let that run off their balance sheet? Or are they going to reinvest that and buy a new mortgage, and in doing so, try to help keep rates low? That remains to be seen. If they don't reinvest it into mortgage, we could see the rates go higher, again, as expected into the first half of the year, but then gradually come down in the later half of the year. And so that's what the idea is presently, that we're going to see those rates come down. So with regard to the stock market and the Federal Reserve's movements, the stock market is pretty overvalued by just about every single metric. Stocks are very expensive. And if the Fed hikes rates, we could see price-to-earnings ratios contract, and that result in lower stock prices. So we're forecasting to see a 10% decline in the stock market major indices in 2022. With interest rates, as I said, we anticipate them to rise. We've already seen that. Mortgage rates start to rise coming into the first part of 2022 already, and get up into the high 3% range, 3.75, 3.8, maybe even to 4%, okay, until these Fed rate hikes start to get inflation under control. Once those start to sink in, that should help interest rates come down, and we should see mortgage rates come down in the later part of the year, albeit from higher levels. So I'm optimistic that we'll see mortgage rates back down in the low 3% range, maybe as low as 3% again. So again, the forecast is to see rates rise to the high 3%, say 3.75 for the first half of the year, and then decline to around 3% at the end of the year. So what does that mean strategically if you are a home buyer right now looking to buy? Well, that's where I help you kind of look a little bit further down the road, and we look at options where it might behoove a buyer to take a little bit higher interest rate now to get lender credit to help cover closing costs, if we know or have a very good inclination that rates are going to come down later in the year anyway, which is what we believe, well, I believe. So the housing forecast, as I said, is expected to continue to rise. Okay, we have a serious supply and demand issue here, where there's much more demand and supply that's keeping home prices up. Now, it's going to be strong, not as strong as it was in 2021, and part of that is because of a little bit higher interest rates that would probably kind of soften things a little bit, but still we expect home prices to go up in the single digits. The supply will increase but remain tight. Tight labor supply chain can cause supply chain disruptions, semiconductor shortages. Why are semiconductors important? Well, because think of all the things in a house like a washer and dryer that have these semiconductors. So these things tend to contribute to the inflationary problem and the higher prices that we're seeing. Rents, however, rents are also going to continue to rise. So if you're a renter right now and you're just thinking, well, maybe I'll sit on the sidelines and hope that home prices come down, I think you might be hoping in vain because, as I just mentioned everything before, we expect to see the rates or the home prices still gradually climb. And rents in the meantime are also climbing. So if you're renting and you have a lease that's coming due this year, don't be surprised if the landlord says, well, rents have been going up, so we're going to raise your rent too. So you're not sheltered if you're renting. So basically the forecast is for us to see mid-single-digit appreciation in home prices, which still provides an excellent wealth-building opportunity. So my recommendation is if you can find a home now that works for you, that's within your budget, make a move on that home. Let me help you strategize a purchase for that and work with you and your realtor to make you successful because it's still a great time to buy and we see the housing market staying strong and we can manage the rates as they fluctuate as they always have in the past. So with that, just want to thank you. Have a great 2022 and we'll be in touch.